Elon Musk says the housing market's going to crash. He's wrong. Stay tuned to find out why. Okay, now, that was quite the clickbait headline. My apologies. It actually happened. So last week there were a series of tweets out there. A gentleman was talking about how housing market's not going to improve any until a lot of people start dying off that forces their homes on the market to sell. And they talked about how there was going to have to be this job loss collapse and just great recession and all this was going to happen, and that would free up houses for the housing market. And Elon tweeted, tragically accurate. He's wrong. I mean, he's right in that if those things were to happen, then it would be tragically accurate, yes. However, let's talk about what's causing the lack of inventory and what's also causing the lack of a crash right now. There's a bunch of groups of people out there that for the last, as long as I can, easily the last 10, 12 years, ever since the last recession, he was saying, oh, this is the year we're going to have a crash. Housing crash is coming. Housing crash is coming. Matter of fact, there's somebody locally here who keeps posting about, oh, there's a huge glut of new home inventory. They're going to go into foreclosure and prices are going to collapse. That's not true at all. It really isn't. And I'm not trying to cast aspersions on anybody else. And nor do I have a crystal ball. However, I know data. I love data. And the data trend is always your friend. If you watch these videos all the time, you'll have heard me say that 100 times. Having said that, let's dive into the data and see what's going on. And for data, I always like, at least for real estate data, I always like going over to Bill McBride's blog. And Bill, he's a fantastic economist. He's my favorite economist, quite honestly, in real estate. He's talking about two themes here, low inventory and few distressed sales. And I don't want to get too much into the copy on this, but I do want to talk about what he's talking about here. So this is the percent of closed-end first lien mortgages. These are primary mortgages. Most of them are going to be on primary homes, might be on some secondary homes. But what I want to point out here is that the little blue line on the bottom, that percentage, you go to the far right-hand side here, you're north of 22, 23% of those mortgages that are outstanding have less than a 3% rate. And then you go that light blue line all the way up to the top on the right-hand side. And now, all of those people are in mortgages that are between 3 and 4%. And you get to the gray area, and then you're between 4 to 5%. So roughly 82% of all mortgages out there right now have less than a 5% mortgage, which leaves only 17 or 18% that are in the 5 to 6 or up to 7% range, which is a very small number. So that's an important part. Another one of the things I want to highlight right here is this one sentence. And it says, the percent of outstanding loans under 4% peaked in the first quarter of 2022 at 65.4%. And the percent under 5%, so all mortgages under 5% is 85.8. So say 86% of the mortgages out there are less than 5%. So why would you trade your 3, 4, or 5% mortgage for a 6.5 or 7% mortgage? Again, the three things that cause that kind of things are death in the family, divorce, or a job transfer. Those are the big three movers on that. Also want to look at credit worthiness, if you will. So actually, no, let's look at loan to value first. Credit worthiness is next. But right now, this is basically how much do they owe? What percentage is their mortgage or how much is outstanding on their mortgage compared to the value of the home? This dark blue line, which is roughly 62%, those people have a loan to value ratio of 60% or less, meaning that they have 40% equity or more in their home. The light blue line is between 61% and 70%, so that's roughly 30%. The gray lines are between 71 and 80, so they're between 20 and 30%. The yellow ones are between 81 and 90%, so say they've got anywhere between 19 and 10% equity. And then the orange one is 91 to 100% loan to value, which is, as you can tell, is a very, very small minority of all loans out there. And if you look really, really hard, you can see just a touch of red at the very top where somebody's actually underwater. And they're, maybe that's somebody who used a VA loan with no money down and purchased in say April or May of 22. And by now there's been some erosion on their house and now they owe a little bit more than it's worth. But again, a very small minority. And I want to talk about that particular thing just for a second here. One of the things we got to talk about is that once somebody's in a loan, their rate is locked so that they have a fixed expense for their housing costs. The only thing that's really going to fluctuate will be their property taxes, and that's in most states, at least here in Idaho, it's not a huge swing back and forth. But I know in some states, when we lived in Texas, we had huge swings where, in Florida as well, where your bill could vary by, over $1,000 year to year. It was shocking sometimes to see how much they would sway. But here in Idaho, it doesn't move very much. And the other swing on that would be your property taxes. Your property taxes, but also your property insurance. So if your property insurance goes up significantly, that'll move your mortgage a little bit. But by and large, they're fine, and they're not going to see these swings or the increases in their housing payment that renters see. Renters right now are still seeing 5 to 6% increases every year, and you should not see that big a swing in a 30-year fixed mortgage. Just want to make that side note there. So let's go back to the screen here, and we've talked about the loan-to-value ratios. Let's talk about the mortgage origination by credit score. So when the mortgages were issued, what was the credit worthiness of the people getting the mortgage? And right here, this light blue line, they were north of 760. Their credit score was 760 or greater. And as you can see, that was the vast majority of all the COVID-era mortgages that were issued were north of 760. And then you go to the dark gray line, you're looking between 720 and 759. Still tier 1 credit, most comparisons. So you have roughly, gosh, I don't know, you're probably talking high 70 percentile, low 80 percentile of all loans issued during COVID era are, tier 1 720 or greater. And then you get into the light gray, and you're talking 660 to 719, which would be FHA range based on the credit score. And then you get down there, and there's a small minority in there that were between 620 and 659. And at the very, very bottom, you got people less than 620, but those would be hard money loans and other type of secured loans there. Let's talk about this thing. So you've got a huge majority of the loans that are under 5% and probably a true majority under 4%. You've got people who owe less than 70% of the loan-to-value ratio on the house, and you've got people with fantastic credit scores. So you've got equity, you've got great credit scores, and you've got low mortgage payments. So that's the safety net. That's the good news that prevents a crash. The bad news is, especially for buyers, the demographic for buyers coming in now, when you look at Gen Y, Gen Z, millennials, wrap those all together, it's a bigger group of people than the baby boomers were on a total head count. And the largest segment of those Gen Y, Z, and millennials turn 30 in 2025, which is peak first-time home buyers. So that's a year and a half away. So we have some time to figure out what's going on. And there are some things going on. Matter of fact, we just saw this morning that there is a bill going through the House of Representatives. And I forget one of the catchy names they always throw on these things, but the gist of it is that they want to double the capital gains exemption on the sale of a home. And it's primarily for the high value states, New York, California, any of the coasts basically, where they want to take, right now, if you're a single person, you sell your home, or unmarried person, how about that? And you sell your home, you have a $250,000 exemption on the first profit, if you will, the gain that you made on the sale of that house. And then if you're married, then you have a $500,000 exemption. And what this bill would effectively do, if it goes through both houses, or the House and the Senate, is that it will double. So as a single unmarried person, you can get $500,000 exemption on capital gains. And if you're married, you get $1 million exemption on the first $1 million profit capital gains on the sale of your home. However, while that's certainly well-intentioned, that's not what's holding people back from selling their homes. It's the low mortgage. So quite honestly, they need to go back and play with mortgage rates and figure out a way to get mortgage rates down before we see any real movement in the housing market on that side. The good news is that on the new home front, the builders have kept on building, especially even here in Idaho, where everybody says, oh, the bubble's popped and the market's crashed. I just saw 2 days ago, Redfin came out saying that the bubble has popped in Austin and Boise. And it's like, homes are still selling here. And we're certainly seeing multiple offers from time to time. So it's not totally crashed the way the headline would make you think. However, the new home builders have been going like gangbusters this entire time. They backed off a little bit in the fourth quarter of last year. We saw some people stop. If the foundation wasn't poured or laid, they were not moving forward on any new projects. Other people we saw, like Hunter Homes, Boise Hunter Homes, they were out there and they were selling off some of the lots they had within Dry Creek to other custom home builders that would build homes that were similar to the ones they were building, but it was great for managing cash flow and just making sure that everything could keep moving forward the way it needed to. And then Toll Brothers is certainly breaking ground every time we turn around and look at anything. So there's plenty of great home builders building homes here, which is taking up the slack of the existing resale inventory being tied up like it is. We're going to be watching this and talking about this quite a bit, probably too much to be honest, but it's the most pertinent point in real estate right now. Interest rates are the biggest issue we have, and there's not much we can do about that. The economy is going to drive that along with the Fed. But inventory is equally as important, because it doesn't, you could have 1% interest rates, but if you don't have any inventory to sell, doesn't matter. Nobody can buy anything. So they're both the two fulcrum points, if you will. Interest rates, we're not going to cover quite as much because they're not moving as much, but the inventory issue, we're going to keep a close eye on because we have to have inventory. Thank you for watching. Please subscribe to our channel if you like what we're talking about. If you have a topic you would like us to cover, please drop a comment down below in the comment section. We'll be happy to get on it as soon as possible. You take care. Thanks for watching. We'll see you soon.